Hey guys, what is going on? Welcome back to my Robinhood portfolio. Today I thought I'd talk a little bit about pattern day trading. This has come up quite a bit recently in the comment threads. Viewers asking about pattern day trading restrictions. Why am I not subject to pattern day trading restrictions? As you guys know, I do a lot of day trading, and I typically do more than 4 day trades in the 5-day trading period, which is sort of the limit or what you are considered to be a pattern day trader by definition. So I thought I'd just quickly talk about the definition here to be a little bit more precise and clear with exactly what pattern day trading is, and then how I avoid being restricted with regards to pattern day trading. So pattern day trading, kind of alluded to this a little bit earlier in my comments here, but a pattern day trader is a trader who executes 4 or more day trades in 5 business day period on a margins account. So if you do 4 day trades or more within 5 business days on a margins account, you are labeled as a pattern day trader. And as a default, any account in Robinhood is a margins account. And really what we're talking about is after a sale, you can immediately use your funds again. You're basically borrowing money from Robinhood during the settlement period to reuse your funds. And you can call Robinhood to get your account downgraded to a cash account, but that kind of defeats the whole purpose behind the margins account. If you, for example, had $5,000, bought stocks worth of $5,000, sold them off, let's say for $5,050, made $50, that $5,050 would be held during a holding period. You would not be able to reuse those funds to buy another stock. So it kind of defeats the whole purpose behind avoiding the pattern day trading restrictions. On a margins account, you would be essentially borrowing money from Robinhood during that holding period, so you can reuse those funds. So you can downgrade to a cash account to get around the pattern day trading rule, but again, it kind of defeats the whole purpose of the margins account and the pattern day trading. You want to use all your funds over and over again, and if you do a cash account, you have to basically wait until those funds are cleared during the holding period. So yes, you can potentially get around the pattern day trading rule by having a non-margins account, but again, it kind of defeats the whole purpose. The other way to get around that is that if you have greater than $25,000 in your account, you are no longer restricted to the pattern day trading restrictions. And you can kind of see this on the top here. Basically, again, defining what a pattern day trader is and why you should care about being labeled as a pattern day trader. And really, it's all about restrictions. If you're labeled as a pattern day trader, again, if you have 4 or more day trades in any 5-day trading period, you're labeled as a pattern day trader. And if you have less than $25,000 in your balance, you're no longer able to day trade for 90 days. So basically, you have to wait 90 days before you can start doing any day trades again. And kind of an interesting story behind the whole reason this is put in place, but essentially the FINRA, as you guys know from a prior video or prior videos that I've put out, there's a lot of self-regulatory organizations surrounding the stock market and trading. They basically consider day trading to be very risky, and they consider investors who have less than $25,000 in their account to be very high-risk traders, less sophisticated traders. If you read some of the literature surrounding trading and day trading, so they have this rule in place where basically if you have less than $25,000, you can only do 3 day trades in the 5-day trading period. If you do 4 or more, like I said, you're labeled as a pattern day trader, and there are restrictions placed on you. These are really done by the clearinghouse. The brokerage account essentially is abiding by some of these regulatory restrictions, so they really aren't doing it themselves, or really don't have any interest in doing them themselves, other than abiding by, again, some of the regulatory mandates on them by the FINRA, the Financial Industry Regulatory Authority, as well as some other regulatory bodies as well, such as the SEC. So I hope that makes sense. Again, that's kind of what a pattern day trader is, how you qualify as a pattern day trader, and why you should care about being labeled as a pattern day trader. And if you take a look here as well, it gets a little bit more complicated with regards to what's considered a pattern day trader. You can see here again in bold here, this is the big thing about the pattern day trader, and this is how I get around the particular restrictions. I have $25,000 or more in my account. If my account balance were to fall below $25,000, I would be restricted like everybody else because I'm considered to be a pattern day trader. But since I have greater than $25,000, I'm not held to those restrictions that pattern day traders are restricted to, if that makes sense. So a lot of folks think that if you have greater than $25,000, you're not labeled as a pattern day trader, but you are actually labeled as a pattern day trader. It's simply because I have greater than $25,000, the restrictions don't apply to me. If my balance were to fall below $25,000, I would not be able to do day trades for 90 days. I think this has got a few traders in trouble in the past. They were labeled as a pattern day trader, but they had greater than $25,000. They did unlimited trading. Their balance fell below the $25,000 limit, and they were no longer able to do day trades, and we're kind of wondering why that is. And that's kind of what's happening here, is that you're labeled as a pattern day trader, but because you have greater than $25,000 in your account, you're not held by those restrictions. And again here, it's kind of going through again in bold here. Please note, PDT protection should be used as a guideline. Do not guarantee that it will prevent you from being labeled as a pattern day trader in every circumstance. And as you guys know, by default, the Robinhood application only lets you do 3-day trades in any 5-day trading period. It prevents you from doing that fourth, so you're not labeled as a pattern day trader. You're not locked out of doing any day trades for 90 days or 3 months. And it gets a little bit more complicated with regards to what is considered a day trade. You can kind of go through and kind of see some of these examples here. 1-day trade, 1 buy, 1 sell. If you start with 0 shares, you buy 1, you sell 1. That's considered a 1-day trade. And again, it gets very, very complicated. I sort of think about this as how many directions or times you buy and sell a stock in a particular day. If you buy and sell, that would be 2-day trades. If you do that 3 times, that'll be 3-day trades. But it gets fairly complicated. For example, here, let's say you start with 10 shares of a particular stock. You sell 10, then you buy 5 and sell 5. You can see here your first transaction was selling ABC that you held overnight. It doesn't count toward your day trade, so it's still only 1-day trade. However, it's a non-leading sell. You start with 10 shares, you buy 1, you sell 10. Despite already owning 10 shares of a particular stock, you still bought and sold, so it's still considered 1-day trade. It gets very complicated with multiple buys and sell. For example, if you start with 0 shares here, you buy 1, you buy 2, you buy 7. So basically, you bought 10 shares and you sell off 1, 5, and 4. You can see this is considered 1-day trade here. There's only one change in direction. So like I said, any change in direction is basically considered to be a day trade. So you build up to 10 and then you went down to 10. That's one direction, 1-day trade. Let's say you start with 0, you buy 50, you sell 15, and then 35. So you sell off that 50, buy 10 and sell 10. That's considered 2-day trades. Again, 2 different directions there of buying and selling. So a few more examples here, but really all about direction. If you buy and sell, I consider that to be 2-day trades. And I always typically buy and sell the same amount of shares when I do my trades to make it easy to keep track of a lot of this. But again, I don't really have to worry about that because I have greater than $25,000 in my account. So I hope that clears things up here. Very basic. 4-day trades or more in any 5-day trading period, you get labeled as a pattern day trader because by default you are basically enacted in a margins account on Robinhood. You can call Robinhood to have that downgraded to a cash account, but if you do that, you can't use the proceeds of any funds for I think it's like 3 to 5 business days during the holding period, and then once those clear, you can reuse those funds. So if you had $1,000 in your account and you're trying to do a bunch of day trades, well, you can't use your money in that again for another 3 to 5 days. So if you sell $1,000 worth of stock, you basically have to wait 3 to 5 days. Kind of defeats the purpose behind doing multiple day trades on the stock market. So typically we just do up to 3 and just kind of wait. I'd rather do that on a merchant's account than not being able to use my funds for 3 to 5 days. And a lot of what I do as well is smaller day trades as well. A lot of these I could probably incorporate into 1-day trade and or do some swing trades. If you buy on one day and then sell off on the other day, it doesn't really matter if you're doing blue chip companies. That's a little bit more minimal. Penny stocks, a little bit more difficult to hold overnight. You can hold them overnight, but they are much more volatile. You can lose a lot more money much more quickly than with blue chip stocks. But again, it's all about managing risk, adhering to best practices. So don't want to make the video too long. Just wanted to quickly touch on pattern day trading. I know that's come up quite a few times recently in the comment threads. So I hope this has made sense. And you can also jump into Robinhood like I have here. Click on help, click on trading, and then click on pattern day trading. It kind of goes through exactly what the definition behind pattern day trading is, why you should care, how Robinhood is counting these particular trades, how you can be prevented from being labeled as a pattern day trader with the automatic protection in Robinhood here. and then also some particular examples of exactly what particular trades, how many day trades would be considered in each of these particular scenarios. Kind of cool. You can also Google this online. They have a lot more scenarios with regards to buying and selling particular stocks. So, if I don't want to make the video too long, I'll kind of end it here. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. If there's any comments about this, leave them down below, or any particular part of this that you are a little bit unsure about, if you have questions about, just leave the comment down below. I'll try to get back to you guys as quickly as I can. If there's anything I said incorrectly or you'd like to add to the discussion, so I'll leave it down below as well. I can put out an updated video if I said something incorrectly here. So yeah, kind of with that, I'll end the video. As always, if you enjoy my videos, like I said, feel free to like, share, and subscribe. And until next video, we'll see you then.